The stock market is starting to see a seismic shift in its sentiment. In this video, I want to explain to you guys exactly why the market has stopped reacting to all the bad news that has been coming out over the past few days. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing I want to address is what could be happening in the upcoming Fed meeting. As you can see right now, expectations are actually at all-time highs for a 100 basis point hike on the 26th July meeting. Now, in my opinion, this is overblown, and the Fed member Bullard did come out a few days ago and saying that this is actually being overpriced by the market. And I tend to agree, because at the end of the day, core CPI is a lagging indicator. The real indicator we want to look at for the status of inflation is core PCE, because that excludes energy prices, which are ridiculously volatile and that are completely out of the Fed's control. As you can see, core PCE has already peaked. And this is a big reason why we're starting to see some risk-on rallies in the stock market, with stocks like AMC and GameStop going higher, and even my own growth portfolio, which is filled with a lot of unprofitable companies, starting to go higher a little bit. Core PCE is the main indicator that the Fed uses to judge the status of inflation. And as you can see, over a historic period, although there is not a one-on-one correlation between PCE and CPI, PCE tends to lead CPI data. As you can see, even back in the 1970s and 80s, when we were experiencing record high inflation, core PCE always topped before CPI data. And the simple reason for that is obviously because it includes oil prices, which are very slow to react to changes in consumer demand. And even on the opposite side, when core PCE bottomed, CPI tend to bottom right thereafter. We saw that in the recession of 2008, and we also saw that happen at the end of the 1990s, along with at the very start of the 1990s. And as you can see right now, core CPI is well above PCE, but at some point that is going to change. And with the Fed's action already being priced into the market by a significant rate, as seen by the 5-year break-even and obviously the 10-year Treasury yield, I feel like we are much closer to a bottom than many people expect, even though a lot of retail investors still think the market has plenty of downside. But as you guys know, most retail investors tend to be wrong, and they tend to be bearish at the time you actually want to be bullish. And that's the reason why many people don't make a lot of money from the stock market. And so if you want to be serious about your investing career, then you need to pay attention to this very simple macroeconomic data and focus on the leading indicators instead of reading the headlines. The 5-year break-even rate right here actually tells us how inflation is expected to perform within 5 years. So people are expecting that by 2027, inflation is going to be sitting at around 2.56%. And as you can see, this is significantly lower than where we were at the start of April. And this is exactly the reason why so many stocks have actually been performing relatively well, even though the S&P 500 is still going down and sideways. And the main reason for that is obviously the XBI indicator. I talked about this in my video last week because this is a risk asset indicator. This indicator peaked in February 2021, well before the S&P 500. And the reason it peaked is because inflation and the CPI print in Feb came in ridiculously high, and it broke a very historical downtrend in inflation. But now we are starting to see this index actually bottom. As you can see, it put in this very nice double bottom, and we also saw a record amount of volume on this specific candle. What does that show us? It shows us that exhaustion of sellers might have already taken place. And as we all know, risk indicators always tend to bottom before the rest of the market. And that is exactly the trend we are seeing right now. But obviously the story doesn't end there. Even gas prices and commodity prices have been falling very fast over the past 30 days, even though most people are not seeing that reflected at the pump. And the simple reality is that it will take at least 4 to 6 months for that to be reflected at the pump. And by the time that happens, the stock market might already be pricing that in. As you can see, not only has WTI crude collapsed over the past 30 days, but even something like gold, silver, and corn have fallen off an absolute cliff. And again, these are leading indicators of inflation, not lagging indicators. And this tells us that down the road, we are starting to going to see some relaxation in the prices that most consumers face, even though yes, the supply chain situation is still poor and that there is still going to be price gouging from a lot of consumers and retail investors. But the story doesn't end here. Another thing many investors are completely forgetting is the very popular bullwhip effect. As you can see, what this essentially tells us is that very small changes in demand from consumers and customers tends to be reflected and amplified at the suppliers. And this is precisely what has caused the supply chain situation that I just talked about. And so if this can take place on the upside, where if demand goes up, we start seeing big bottlenecks in the supply chain, then this will also take place on the opposite side, when if demand starts to slow down, we will see an amplification to the supply chain, and that will result in a much bigger and faster accumulation of inventories, which obviously is going to have to cut prices for basically every single good and service that us consumers tend to buy. And that is exactly why so many people like Cathie Wood have been warning us that the Fed's actions might be too fast. The Fed simply needs to be patient and wait 6 months and sit at their current interest rate levels to see how the economy itself figures itself out. Because we already saw a recession in the first quarter, and chances are the second quarter is also going to be negative. And so that already shows us that supply is starting to come back online, and that production as a result is starting to fall. And if the Fed is too aggressive with this, we could be going into an actual recession in 2023, which I guess the market just hasn't priced in just yet. And so, in my opinion, not only is there the risk to the downside, but there's also the risk to the upside when it comes to the Fed funds rate. And yes, although there's a lot of uncertainty and that does make some people want to sell stocks, I would not be as bearish as many people are on the market and on forums. Because as you can see, throughout every single catastrophe and calamity over the past 100 years, the stock market has always recovered. We have been in significantly worse situations that we're experiencing right now. Yes, inflation is high, but inflation is actually a good thing because it shows us that there's economic growth. The Fed actually has a positive 2% inflation target for a reason and not a negative 2%. And right now we are seeing just a correction in an over-hot economy. And so if there's ever been a better time to buy the dip in your favorite stocks, I think right now has been a great time. And I don't think we've ever seen such a good and certain buying opportunity since probably 2008. And in 2008, we actually experienced deflation. So the situation was probably a lot worse back then than it is right now. Simply, we are experiencing a pullback in the rapid economy that we are experiencing in the US and the productivity gains that we have seen due to the COVID pandemic. So before you decide to either sell your stocks or panic sell out of the market, make sure you guys consider this graphic, because I think this puts into perspective exactly what we need to consider as long-term investors. But as usual, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below whether or not you guys are buying the dip, or do you think there's a lot more downside left in this market. Either way, I'm still buying stocks as an investor. But as usual, I'd be love to hear your opinion. I'll see you guys in the next one. Take care.